Hey everybody, it's Swaminathan. I wanted to do a video because right now, as the market stand, we are in May. Today is May 15th, 2014, and as the market stand today, the S&P is at all-time highs, the Dow is at all-time highs, the Nasdaq is off. It's not correlating to the S&P and the Dow, and most importantly, the Russell is particularly down. So if you see the last 3 months, the Russell has been down, and it's down 10%. So obviously there is a divergence here. Now, one of the things that is the strange thing in the market is that if you look at bonds, now bonds are generally you wouldn't have to look at it, but always keeping one eye on the bond market is a very important thing. And right now, actually, it's correlating in a very big way. The market is correlating in a very big way, and it's actually a very strange correlation. So as the S&P is pushing towards all-time highs, in fact, it is at all-time highs, the bonds are also moving up. So now that's first of all a divergence because you can't have the S&P and the bond market moving towards the highs. So money flowing into the bond market generally means the smart money is concerned about the stock market. And as you can see, the bond market is moving up. Now, how do what's an easy, and in fact, even within the bond market, it's very specifically tracking the the 10-year note. Okay, so the 10-year is the benchmark note based on which all the mortgage rates and everything are set. So the 10-year is a very important indicator. Now the TNX, it's not a it's the 10-year interest rate, and it has a multiplication factor of 10. So it closed at 25.4. That means the 10-year rate is 2.54. So as you can see, the 10-year has been coming down, the yield has been coming down, and that's not a good sign because when the S&P is moving up towards all-time highs, the 10-year is also supposed to go up because as the economy grows, as the market grows, interest rates are supposed to go up. But because interest rates are going down, that's why you're seeing the bond market going up, because the bond market, the bonds and the interest rates are inversely correlated. So as the interest rates go up, the prices of bonds fall, and as the interest rates go down, the prices of bonds go higher. So you can see there's a demand in the bond market, and people are buying bonds. While at the same time, we have the S&P making new highs. As you can see, the intraday high was 1902 on the S&P, but it did not close there. It got rejected at that level, and it closed around 1897. So we've not still broken the 1900 barrier yet. However, it is still at all-time highs, and therefore the strange thing is, why is money flowing into the bond market? And you can see it's a steady flow. It's not something that is just happening over the last couple of days. You can see it's a constant series of higher highs. And of course, this is not the all-time high for bonds, but regardless, when money flows in from 130 to 137, which is a big, big move in the bond market, and you can see the interest rates similarly have been coming down. The 10-year rate is at 2.54. It was at 2.82. In fact, it was above 3% also, and it's come down to 2.54. So this divergence has to break because both of these cannot continue. The S&P cannot continue on all-time highs, or the bond market cannot keep going up and the interest rates cannot keep going down, the 10-year interest rate, that is. So one of these has to give, and the question is which one. In general, the bond market is considered to be the smart money. So, if whatever the bonds are doing, whatever the 10-year is doing, that is generally considered to be smart money. So basically, I think everybody is now expecting a correction in the S&P. So that's something to watch out for. And you can, the easy way to track the 10-year is this. It's just an index. It doesn't get traded or anything, but it just tracks the 10-year interest rate, and it has a multiplication factor of 10. All right. If you have any questions, please send an email to info@optiontiger.com. Thank you.